Hey everybody, good to be here. I hope you guys are having an awesome day. I had a fun day, lots of shows to do, and definitely some trading to do. I think we've entered into sort of this new phase of the market where we're just kind of grinding up. I was talking about it on a couple shows today with Brent from Spot Gamma as well. So we're talking about how this is one of the most hated rallies, or I don't know if hated is the right word, but it's almost like one of the least participated in rally that we've had in many years because everyone got bearish. Ed Yardeni and everyone was just kind of out lowering their targets for the S&P. And I don't think anybody saw all the Trump flinches coming, right? So the Trump flinches heard around the world um, really kind of changed the texture of the market. The first was the bond put, right? When we had this existential risk at under 5,000 on the S&P, then we started to rally back, and then it was 90-day wait periods for tariffs, and then of course, a sort of a deal with China, rather another 90-day wait period. But really what it does is it kind of takes off that growth scare that everyone was worried about, right? This sort of implosion of the global economy. And and that's a big thing, right? The markets can deal with higher rates. The markets can deal with a little bit of inflation. They don't mind a little bit of inflation, in fact. Good companies can pass on cost to people. It may be difficult for regular folks trying to afford things, um, but markets can handle all that. What they can't handle is a growth implosion, right? So this is what we've kind of sidestepped at this point. And for almost a month now, I've been saying, listen, I think the pain point is up because so many people are out. So just think about all the people who've gotten out of this market. There was a chart by Goldman that looked at the AAII sentiment, and it was 50% or more bearish views, 11 straight weeks. Guess when the last, is there a chat, David? I wonder if anybody can chat in here. Um, Imagine when, guess when the
Yeah,
last time
yeah.
was that.
Chat
Yeah,
is
we
open.
can.
Did you
Oh,
see the
okay, the
chat?
chat is open. Oh, okay, here we go. So yeah, everybody was just covering shorts. Exactly. It was very mechanical. It was short covering. It was really everyone. If you looked at the option skew, so one of the things that I do is I teach people option. I teach people about this Greeks and skew and looking at those little nuanced things underneath the hood of the market that can you tell you what's really going on, where the fear really is. Digging into the VIX and VIX futures and backwardation and contain all that stuff that kind of gives you that extra sense of what's happening there. And so, really there was this sort of skew exploding and everybody just getting massively bearish. And it really feels like, in fact, if you look at the flows, people were still selling into this rally. And I don't think any of that foreign money that left has come back in. So on the one hand, you could sort of say, well, that's a bit bearish because, well, people they're sticking to their guns and thinking that, it's the end of US exceptionalism, which I think is complete and utter rubbish. I think people are going to regret even saying that. The US leads in something like 9 out of the 12 major technologies in the world. Add them up, leads in almost all of them, and certainly leads from a consumer standpoint, from many different, from the standpoint of many different metrics. I think that foreign money is going to regret it, and that's what's going on in this market. A lot of people have made a mistake, and they're looking at this market going, "Oh my goodness, I might be about to underperform this year if I don't do something about it." So there's really room for a lot of people to come back in. Yes, we're going to get a slowdown at some point because everyone just went out and bought tons of stuff ahead of tariffs. So absolutely, we're going to get a slowdown. But that slowdown could very well come with some tailwinds from tax benefits, tax cuts, some tailwinds from regulatory things. So the market is really one thing I've learned at 30 years. I was a market maker for 15 years, pro options market maker, volatility arbitrage, options arbitrage, trading long gamma, short gamma, long options, income strategies, very big. I've traded $1 billion in options, income, and other kinds of strategies over the last 30 years. So $750 million in cash flow generated for investors, for students, for everyone around, all these people around the world. So a lot of depth of experience there. And if there's one thing I always remember, one of the major things I learned was somebody said to me once, they said, never underestimate the ability of the market to climb a wall of worry. Absolutely, things felt terrible at 5,000, 5,100, but never underestimate how the market will do the opposite of what everyone thinks. And that's the pain point. And so I've been saying for a month on all these shows, pain point is up, pain point is up. I didn't quite think we get this far up, but here we are. And now we have the potential for more people to go, oops, I got to get back in. So these are some of the things we talk about in my programs, the things that I teach. I have mentoring programs. I have programs. I have a Crush the Premium program, hedged income program. So I teach people how to basically generate that income 1 to 2% a month. Doesn't sound like much, but it adds up. But the important thing is it comes with a hedge. And nobody, funny, everyone was suddenly talking about hedges. I ran 2 Black Swan downside protect funds. So this stuff is in my DNA. So I teach people how to do things sensibly with guardrails using my 4 pillars of edge. And it is not complicated, but it is about staying within the rules, staying within those guardrails, and sticking with it. And it's hard to stick to the rules. There's no question about it. It's even hard for me. I step outside once in a while and I get slapped upside the head. But every now and then we are reminded that we really do need those rules. Somebody gave me a book today. I can't remember what it was called, but it was the basic premise of the book. The guy said, yeah, it's 300 pages. And he said, you could have written it in 10 pages. And it really came down to take your losses much, much more quickly. He said that was basically, you could have distilled that entire book into the people who do well. Put it this way, George Soros, I think somebody said he was right 30% of the time, and he knocked it out of the park and became a billionaire, right? So the idea is that it is very easy to, make money and feel good about it and you feel like you're on top of the world is when things get a little bit rough. I used to fly small planes, and when it's beautiful out and blue skies and not a whisper of wind in the air, you can fly that plane with your little pinky. It's easy. You can fly it with your little pinky, with a sandwich in the other hand, enjoying the scenery. When that hailstorm rolls in, like it did for me north of Montreal in the Laurentians, and the cloud cover pushes you down to where you're a few hundred feet above the mountaintops, and you cannot find an airport because everything looks the same, that is when your training kicks in. And for me, option training is really like that. And this is really a world. I'm sure we have other fantastic presenters in options, and nothing against those people. There are great people out there, but it really feels like this is the age of the option guru grift, where anybody can throw up a website and a YouTube channel and go, yep, I'm an expert. I quit my job in marketing 2 years ago, but now I'm an options expert. I'm going to show you how to make money consistently. It doesn't work that way. You need to know that avoiding certain situations. So we're going to talk a little bit about that today. We're going to talk about some of the risk gauges that I use, some of the things that you need to be aware of, because sometimes certain metrics, the textbook will tell you, yeah, this is fantastic. This is where you need to be selling the heck out of options, because that volatility risk premium, right? That premium of option pricing over risk is fat. Just you would sell that all day long and all 7 days a week if you could, and you'll do great. There are periods where that's absolutely not true. And so this whole 95% win rates, I've seen 95% win rates where people blow up their accounts because those last couple trades were terrible, because they're doing things like 1 by 1 by 3, like these ridiculous ratio strategies that are not geared at all for retail, but people push it out there. So it's the age of option guru grift. You've got to be more careful than ever with who you're listening to. And again, fantastic people out there. You don't have to be a market maker or have run, or having had run 700, $800 million in income funds. I'm not saying that's necessary for you to know quite a bit about this stuff. I'm just saying that there are a lot of people out there who haven't got a clue. So be careful out there. Be careful of who you speak with, and get the right training, right? You can get the right training now, or you can get hurt and then come back to somebody like me or somebody else 6 months from now, if you have any money left, and go, oh, you know what? I need a little bit of training. So not to scare you, I want, if you have never ever traded options, or if you're new to markets and you're already learning about some of those things that I'm talking about, right? You even feel it inside. You feel that fear at times. How do I overcome that fear? How do I do the difficult things? Often the right thing to do is the thing that is the most difficult to do, right? You're experiencing those emotions because at least half this game is right here in your heart, right up here in your brain. And so those are the things, there's art and science to this. Science, you can probably get from a YouTube video. Hopefully you're watching the right person, but you can get that from McMillan's book. You can get it from Natenberg's book. You can get it from courses. You can get a lot of the science. Nobody's inventing new strategies. The strategies are out there, right? You're not inventing a new strategy. You're not inventing a new piano chord. They've all been invented. It's the way you approach things. It's the process. It's controlling your mind. It's controlling your emotions. It's staying within guardrails that make sense. It's understanding when the market is very risky, and it's understanding when it's more conducive to doing things like income trading, etc. Because there are markets where you're going to want to sit on your hands. And that's hard for people, right? Things are happening. You feel like you got to get involved. You don't. And those are the moments that are going to make a difference for you. Those are the moments in your career where not getting into the temptation, not giving into that temptation of taking that trade you saw on CNBC or some crazy meme stock trade that you heard somebody making tons of money on. It was not getting involved in that made a big difference to your career as a trader, as an investor. These are all very, 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 very important things. And so one of the things that we talk about is the volatility risk premium. So I want you guys to understand that options, people are sometimes surprised to hear about this, but options can be expensive at low levels and they can be cheap at higher levels, right? So what I mean by that is if you've heard of the VIX, which is the fear index, the volatility index, gives you an idea of where it costs to insure a portfolio of S&P 500 stocks. And it can go from 11 and it can go up to 60, which we saw recently. So it can be super quiet. In fact, the mode for the VIX is 12. So everyone thinks, oh, it should be 20 because that's the average. No, no, no. It loves to spend time around 12, which is sleepy time, right? A 12 VIX market is pretty damn boring. It's nice if you're an investor because things are just kind of inching up and pullbacks. They always buy them and things just kind of go up, right? So you want to recognize that. For example, I don't sell covered calls in a VIX 12 environment. I just don't. Now, there may be some stocks that I have in my portfolio that have some idiosyncratic issues, maybe a UNH, something weird going on in the world where the rules don't apply when there's something unique happening. But as a whole, if volatility is very, very low, you tend to not want to sell covered calls. Anybody sell covered calls out there? I'm not sure how many folks are trading options. Anybody do covered calls, cash secured puts? Let me know if it's cash secured puts, if it's covered calls, if it's long option strategies. Are you buying options, which is sort of buying leverage? Or are you doing butterflies? Are you doing just stock? What's everybody's kind of experience in this area? Nope. Shy. Everyone's shy. Well, let me show you something interesting about volatility risk premium. Okay, so volatility risk premium is the price of options versus the underlying movement. So what is that? Well, that's just, think of that as, where am I pricing car insurance versus where's the underlying risk? Selling put spreads. I love that. I love that, Norseman. Put spread's a great way to go. And I just did a video actually on YouTube. If you look up Cash Flow Insiders, you look up a video and I explained why I did a vertical spread on Meta instead of a cash secured put. And I went through my entire reasoning, and I'll show you a little bit about my thought process. Cash secured puts and calls, some cover call selling, Marcia. That's terrific. But funny thing is, so I ran hundreds of millions of dollars in cover call products, and I would present to advisors, and they would say, "Oh, what do are you selling? You're selling calls all the time." And I said, "Well, not really. Sometimes, my base sort of position is I don't really want to sell calls." And they'd be like, "What do you mean, Hans? What do you mean you don't want to sell calls? That's your job." And I'd say, "No, my job, that was my job. Before I took over this portfolio, they were just selling calls all the time, 100% against everything." And I said, "Do you guys wonder why you're underperforming? Because that's a terrible strategy. It's terrible to be just systematically selling covered calls against your holdings. You're quite very likely, I'm going to show you some data in a moment, you're very likely to be giving up a lot of upside performance." And you might say to me, "Hans, well, what's my risk?" My risk is that I get called away and I make money. The stock goes up to my strike price, I get called away, I got all this juicy premium. And I would say to you, and this is what I really start off all my programs, from mentoring to my Crush the Premium, which is a very, very inexpensive price point to get in, all the way to my full-time mentoring. I've got a 1-year mentoring program. And one of the earliest things I say is, it is not a risk to make a bit of money, but it is a risk to give up a lot of upside. And I would say to those advisors, I'd say, "Listen, I am a covered call seller, but I don't want to do it unless I see edge, unless I see a compelling reason from markets." Now, it doesn't have to come from volatility edge, from options edge. I can see other reasons, right? There could be news-driven reasons. There could be a spot on the chart where I'm just, I've ridden a nice long stock up to a certain point, and I think that's a good spot, right? I'm not saying you can't get edge from other places. I think that's very, very important to do. It can't all be based on option pricing. But when I'm not being given edge, especially from the options, I'm not excited to do it. And I said that to somebody recently. I said, they were selling a bunch of cover calls on MSTR, right? Everybody knows MSTR. They're called Strategy now. They were MicroStrategy, and it's Michael Saylor. He just buys Bitcoin. They don't do anything except buy Bitcoin. They've got like a software business. So this thing just is like levered Bitcoin. And I said to them, they were selling covered calls, and I said, "That's not very smart. You've got option pricing trading near the lows of the 52-week range, super, super cheap options. You've got upside skew, which means those upside calls, typically on MSTR, they trade super expensive, right? Because everyone's like, they think MSTR is going to go to the moon, so they're paying up for all these upside calls. They're excited. That's what happened when it ran to 550. Those calls were about as expensive as you can imagine. So that upside skew was flat. It was flat, boring. And this guy was selling calls, and he gave up so much of this last $125 run. He doesn't know what hit him. And I said, "I told you." I said, I don't have a crystal ball. Maybe you're going to sell those calls and MSTR is going to go down. And you'll go, "Hans, I was right. I sold those calls." Fine. You got a little bit of premium. But if this stock goes up, if you think about what your primary risk is, I mean, your risk in a covered call is that the stock goes down and continues to go down. That's really your primary risk. It's capital preservation, right? Covered calls are only going to help you so much. But your other risk is the upside risk of giving up too much upside, right? Think of option selling in general, because cash secured puts are the same thing as covered calls. If you don't know that, chart them. Look at the P&L. Same thing. Use the same strike on both. Same thing, different structure. Cover call is a synthetic put sale. That's all it is. In the money put sale. So I said, well, the risk is that you're giving up that upside, right? So you have to think of that as a risk. If you care about your prosperity, if you're getting involved in stock markets and you don't care about your upside, and you only care about that income component, fine. I have clients who are 68, 72 years old. They're like, Hans, I don't care about upside. I just need that juicy, juicy premium that Microsoft's going to give me. Okay, that's the one caveat I would say. But in general, if you're not at that stage in your life and you're involved in markets and you don't care about the upside, then I think you're doing yourself a disservice. That's why do you want to get involved in Microsoft, in Amazon, in Nvidia, in other non-tech companies that have in Ulta, in Visa, in fantastic companies out there. If you don't care about upside, why do you want to be a part of the grand American capitalist system that rewards people? Look at what were with markets like 100 years ago. S&P was like 1. Why do you not want to be involved in that? So my point is that there is a risk with option selling, and it's that you're going to give up too much upside. So the volatility risk premium is how much more expensive are options than underlying risk. If I'm selling car insurance for $3,000 to some 18-year-old hothead driving a red Mustang, that may not be enough, right? I should probably be charging that kid $6,000 a year, because he's going to get that profile for that particular person, gets into accidents, gets speeding tickets, gets into all sorts of trouble. Now, if I'm charging $3,000 for a little old lady who drives under the speed limit, well, maybe that's dangerous too, but who has a perfect driving record, then I'm getting a lot. That's a nice fat volatility risk premium, right? I'm selling that insurance for way more than it's worth. That lady is never going to cost me anything. I'm never going to have to fix that car or fix a fender bender. I am getting tons and tons of money. But that $3,000 on that kid, he may write off that car, and I've got an $80,000, what did I say, Mustang? I've got a $40,000, $50,000 bill to pay for. That doesn't cover my $3,000. So remember, VIX 12 can be kind of expensive if nothing's going on, but VIX 25 can be actually cheap. So remember, volatility is a relative concept. It's two pieces. It's not just option pricing. It's two pieces, risk and option pricing. So we have to be aware of what's going on out there. And when, we saw recently, the average true range in the market was as big as it was back in the global financial crisis. How's that for realized volatility? That is breakneck movement that we were seeing out there. Double what we saw last August when the market dropped 900 points. So our daily ranges were massive. That is not a time to be aggressive as an option seller, generally speaking, because you're in the eye of the storm. So you want to know when you're in the eye of the storm, you want to know when the storm is coming towards you. You want to have an idea of, is the storm going to pass you by? Is it going to smack you right in the face? And I want to show you something here. So volatility risk premium, I just explained that is how expensive are options versus the underlying movement. We can see over time these green shoots represent how expensive options were relative to the subsequent movement. And so what these green periods are showing you is that, yeah, puts have been very, very expensive for, throughout the last 15 years. Or, this is a 10-year period, right? So they were expensive. That's even a low vol period, man. That decade was like not much going on except stocks going up. So it wasn't a great volatility. It wasn't a great decade for trading option volatility, which is probably a better decade for just staying long stocks. But even having said that, puts were generally very expensive. This is your embedded advantage, right? Cash secured puts or verticals, credit spreads, those kinds of things that you guys are talking about, those make more sense because you're getting that skew. Do you know why those tend to make more sense? Well, stocks tend to go up, but this isn't really it isn't really describing stock movement in a sense. It's describing, well, how much more expensive has risk been priced versus where the actual risk was. And so puts have been much, much more expensive. So there's been an edge in selling puts. What about calls? So here's Hans shouting his mouth off about cover calls not being great, even though he was a cover call seller. Well, I want to show you why cover calls are difficult unless you do them the right way, which we do in the enhanced wheel program. Look at the shoots of green. Where did they go? Where are all those big, beautiful Christmas trees? These are just little scraps of green throughout that same decade. What is this? This is describing where the volatility risk premium was in calls. What is that telling you? What does that tell you? Does anybody want to wager what this lesson should tell you in terms of doing cover calls versus cash secured puts or verticals, things like that? Well, it should tell you that you need to be extra good to do cover calls. You need to be fantastic. You need to be like NBA caliber at doing cover calls because a lot of the time the market is going to drift up through your call strikes and you're going to give up performance. You're not going to lose money. Cover calls, if you go through the strike, you're making money, but you're going to give up some performance. So in this decade, doing cover calls would have been costly in terms of your benchmark risk. That's what we call, well, how did you do versus the basket of stocks that didn't do cover calls, right? What was your benchmark risk? The benchmark is what did those stocks do on their own? And then how did you do selling covered calls? Well, this is showing you that you're going to do a lot worse doing covered calls. So you need all that extra edge I was talking about. You need technical edge. You need to know when to do things. You need indicators. We've got an indicator that I've created that includes a volatility dampener. So it tells you when to dial back your risk. MTI indicator, market temperature indicator, that tells you if it's green, yellow, red. Red, be very careful. Don't do anything. Hedge aggressively. Yellow, nice and juicy, kind of very, depending on, you're going to combine that with charts and, trend lines, things that you're looking at. That's going to give you an idea of where is it good to kind of start absorbing some of those premiums out there, right? Being an option seller. That tends to be a more difficult market. In difficult markets, the stocks aren't doing the work for you, right? When stocks are making highs every 2 weeks, the market's doing the work for you. If anything, you should be buying upside call spreads and things like that because they're so cheap. How do I know they're cheap? Exactly what we're looking at here. Are calls cheap here? Yeah. A lot of the time they're cheap. What were calls like? You guys probably don't watch this stuff, but I watch, put prices versus calls. 400 points ago on the S&P, I was telling everybody on these shows that I do Leduc, I do Option Pit, I do all these different shows. I said, listen, upside is cheap. Nobody believes stocks are going to go up. And they're pricing upside super, super cheap. So what was the opportunity? Was it selling covered calls at 5,500 on the S&P, or was it buying calls? Well, and I do turbo trades. So I don't teach that in the Crush the Premium, but once you get into the other programs, I teach these turbo trades, which take advantage of that expensive skew and play cheap upside. That is using your head as a volatility trader. If you're an options trader, you're also a volatility trader. I hate to tell you. If you don't want to hear volatility and skew and implied vol, you're a sentiment trader. You're a fear, greed, and everything in between trader, and you're a volatility trader. So if you want to trade options, that's fine, but you should understand volatility. And I have another program that might even be my best. It's called the Volatility Ninja. And it gets into all this stuff so that you will never look at options the same way again. And in fact, if you did that course, you never traded an option in your life from that point on, you would be incredibly more well off because volatility is a part of everything, whether you trade futures, if you just own stocks, whatever you do, if you're involved in markets, you are involved in volatility. And understanding it is going to be your gateway to being a better trader, a better investor. 100% wholeheartedly believe that. That is what really sets good option traders from okay option traders, is having those extra senses. It's a little bit of work to understand this stuff. But once you get it, you are going to have the water cooler talk of the day. And once you start explaining these things to people. So here's another chart of volatility risk premium. This is monthly. Look at the volatility risk premium. Positive, 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 positive. This is a combination of calls and puts quarterly. You can see the global financial crisis, COVID, some periods where, of course, options were underpriced. This is the challenge. But the key is you've got to understand that there is embedded, to be the casino, there is some embedded benefit to being the option seller, right? To being the income trader. And that's really where I focus probably 80% of my efforts. The other efforts are Leaps portfolio. My Leaps portfolio is up 18.5% this year, with the S&P unchanged and the NASDAQ still down, what, 9%? It's a hedged Leaps portfolio, which you get in my community as well. You get access to that. I'm going to be making that a standalone as well because it's too good. I want to make it available to people, and it gets into the fundamentals, right? So stuff that makes some people's eyes glaze over. It's important, right? You want good quality companies, right? You want companies that have great moats. You want cash flow. Companies with high free cash flow outperform other stocks over time by 18% a year. 18% a year. Should you be owning quality companies with good cash flow, with good return on invested capital, with good capital allocation numbers? Like, there are certain things that you really need to know. And you might say, Hans, well, I don't need to know that stuff. I'm just trading some stock for the day. I'm going to flip stocks back and forth. I'm only swing trading and I put on an option position for a week or two. You'll change your mind on that when some stock gets halted, like I don't know, some stock, and it gets halted and gets crushed, and you're like, oh, maybe I should be exposing myself to better quality companies. Because when you get caught holding the bag, that takes us back to minute 3 of this talk, which was you got to avoid stepping in the piles of what as much as possible. We can't always avoid that. You cannot be in the world of risk without having risk. But you can absolutely get better at avoiding risk. You can absolutely be more disciplined and know when it is better to sit on your hands, for example, because realized volatility looks like this. It's pointing straight up, like it's pointing at the moon. And your friends are all going, no, I'm selling cash secured puts on semiconductors, even though the chart looks like it's falling off a cliff after an 8-month uptrend. And everyone's like, oh yeah, no, we should be selling cash secured puts all day. We haven't seen these prices in 4 months. That's when you should be recognizing what volatility is doing, what the chart is doing, and let them have their fun. When they own Dell at 160 and it's trading at $90. That's where you were the smarter one going, this is looking a little so-so. I'm not saying this is perfect, right? Art and science. But if you can get better at both of those things, you will be better at this game. You will have a shot at this. You will have a very, very good shot at this. And I'm not blowing smoke. Anybody in my programs will tell you that I am not a BSer. I can't do it. I see these people BSing with these crap. Oh, 98%. This one guy I watch sometimes, he's like, yeah, 93% on closed trades last year. On closed trades. So you didn't close the bad trades, or very few of them. You were very selective about closing your bad trades. So you did really well on the trades you closed because those were up money. But the ones that you didn't close, we don't have to talk about those, right? Again, options guru grift, complete and utter crap these days. And it upsets me because this is this is your money, right? These are real people trying to get better and really taking somebody at face value and saying this person seems to know what they're doing. And all they're doing is churning. They're churning. Why do you see the same ads for 3 years? Because they have happy customers? No, they need more and more and more customers to replace the ones who've left. So this is not an easy game, but it can be learned and it can be absolutely mastered over time. And when you have somebody like me, if you learn from me as a mentee, or as in my programs, or if you're in my community where I'm telling people what I'm doing all the time, I'm teaching them. If you learn from somebody like that, you can compress the art part of it, right? The science part you can learn all day long if you're studious, you know. I, but a lot of people aren't even studious. So you've got to figure out, do you want to do this? I have people sign up for courses and they never watch 1 second of it. Are you committed to being better at this? I hope so, if you're putting real hard-earned money at risk, because it can be learned and you can make a real difference in your life. So 1 to 2% a month, I can show you my hedged method. My Leafs portfolio is a hedged slight cash flow slant to it. We got to be careful with those, right? With Leaps, you got to be careful where you sell those. They're called diagonals. You got to be careful with the income portion of it, but it's hedged. So when the market swooned this year, I made a bunch of money on hedges. Not a ton, but I made a bunch of money on hedges. I had QQQ hedges. I had VIX hedges. I've got a current SPY hedge that's getting hurt a little bit, but the portfolio is gangbusters, right? So sometimes, why do you own house insurance? Well, because it's worth it. You don't want it to kick in. Sometimes it kicks in. You monetize that hedge in markets. But in general, you want the market to go up. Sometimes those hedges are going to cost you a little, sometimes you're going to make a little. So that's one way to sort of think about hedges. As I said, I ran those downside black swan funds, and nobody was concerned about losing a few percent a year to hedge their portfolios, right? That gives you peace of mind. It's funny because the first 6 months of 2024, we saw some of the lowest put skew that we'd seen in like a decade. And what that means, guys, is the put skew is that tendency for people to pay up for downside protection in the market. It's very pronounced in the index, in the S&P, in the QQQ. It's very pronounced in index, but it's still there quite a bit in regular equities. And it's up there because markets tend to crash down. They don't crash up, right? So they charge more for that downside, and people are mandated to buy protection, right? Funds are out there and they have to buy protection. So market makers and the supply is like, okay, great, we're going to sell you these, but they're more expensive. So nobody minds, spending a little bit of money on some protection because you don't really want it to kick in, right? What are you doing here? It was a 627. Okay. So let's move on here, folks. So I'm going to show you a trade that I did. So here's a simple trade, right? We don't have to get into all these crazy trades that sometimes we do. Again, the bulk of what I do, income trades, cash secured puts, verticals. So as I said on Meta, when I started to see I'm going to give you a tip here that I want you to take to heart, because this is a really, really cool thing that I've got. I don't know if any of you use bar chart, but it's a terrific suite. Their prices are about to soar. I've always said, like, quietly, I don't tell them, but I've said, listen, this is cheap. So my students, I say, go out and get it. Get the 2-year Get the 2-year program. I'm not even going to give you my affiliate link, which I make money off. Well, maybe I should because I think you might get an extra good price. But it is phenomenal. You can put in there are scanners in here. I use it to scan for stocks that are acting well. The fundamentals aren't that great on it. And the gamma profiles aren't that great. That's more like spot gamma and those things. So if you're into gamma, which you guys probably aren't, but like this idea of, where is there more risk in the market because of where dealers are positioned, they're working on that. But a lot of things are really cool. You can scan for specific strategies, condors, butterflies, horizontals. Horizontal spreads. You've got vol charts. And I think this is maybe one of the coolest things. You really don't find this. So you can scan. Remember, I told you this volatility risk premium. You want to be better at understanding where volatility is, right? So let me give you an example. Here's MSTR. The blue is historical volatility. So all that is that's the risk. Remember, I told you about there's option pricing, the cost of the insurance, and then there's market movement. That's called historical, and sometimes it's called realized. They're really interchangeable, and they just mean actual movement. So the blue line is how's the market been moving? It looks backwards. It goes, well, how has MSTR been moving? The gold line is option pricing. It's saying, well, how is the market going to move in the future? That's all this is. Actual movement versus where is future movement price. Actual movement looks backwards because we don't know the future actual movement. We can only look to history. And it says we've been moving like this. Option pricing is always trying to get a read on where is future movement going to be. Now, it's going to be based somewhat on past movement because what else does it have to go on, right? If I want to insure that 20-year-old driving a red Mustang, what else do I have to go on except looking at what past 20-year-olds who drive Mustangs, male 20-year-olds who drive Mustangs, what is their driving record like? How much are they going to cost me? That's what you're doing. You're looking into the past in order to price the future, just like an insurance company. That's what options markets are always trying to do. Now, they'll deviate at times. That's where opportunity can come from. And one of the great things about volatility, if you end up taking the program and learning more about volatility, is that volatility is mean reverting. It goes up, it goes down. Make sure, I think my clock's wrong. 6:27 it says. That's really weird. It's 6:42. Okay, guys, we won't go too long. We'll leave time for some questions as well. So every now and then they'll deviate. But one really cool thing is you can kind of get a sense for, like right now, options have really come down, right? So I've been trading MSTR because it's trading at a very low percentile, meaning very low level of the year. So I've been making money long MSTR strangles rather, not straddles. I've been long strangles. And they've been doing great. Could have done even better. I wasn't patient enough, but they've been doing great because they're cheap options and you're getting a lot of movement. That's where the opportunity was, not in selling cheap covered calls against your stock and giving up tons of upside because options are trading at near the lows of the year. Where's the upside in that? There's only giving up upside. It's not a good trade. So it's just, and again, it's not crystal balls. It's positioning yourself according to the edge you're seeing as much as you can. So here you can see really cheap, the realized movement. So the stock's been moving around quite a bit suddenly, and I've been playing this since the fall. And now, it's starting to quiet down a little bit, but I've had the move. I've had that realized move to the upside. So I've been making a little money. So what I would do is I would say, so one of the examples I gave is I put that meta vertical spread on. So this is something that you'll learn in depth in Volatility Ninja. And if you I have a bundle, Crush the Premium bundle, you get Volatility Ninja, you get the Crush the Premium method, which includes the 1% and 2% weekly and monthly income methods with a hedge, right? That's what everybody kind of loves. They're like, tell me about the 2% method. I need 2% a month. So they want to know about that. And then you get the Volatility Ninja, and then you also get my Nomad courses, which is my Iron Condors course. And most people do Iron Condors wrong. That's the funny thing. When you've done this for so long, you look around, you go, like the decay charts you see out there for options, people are following the wrong decay charts. They don't. They don't act like that. You can't just say that at the monies, out of the monies act the same. They don't. Out of the money options have a ability to collapse. Those are called the wings. They collapse much more quickly. You approach those kinds of income trades with a very different viewpoint because they don't act the same. But everywhere you look, everyone's kind of talking about this basic, this decay curve that isn't really that accurate for out of the monies. So what I look at is I go here and I look at the IV rank and the IV percentile, and I've got videos that explain this. So we don't have time to get into it too much. But percentile IV rank, they're different, but they're similar in a way. They're trying to give you an idea of where is current volatility. Is it low? Is it high? Is it mid range? And so you can kind of see when the stock starts coming off. When I see the blend of percentile and rank get above 50 or close to 50, that is a sign that there's something going on out there that you need to respect. It may be coming from the broader market. It may be coming from this particular stock. UNH has been probably there for a long time, and it just got cut in half. It's been just one hit after another. There have been signals there. I haven't been short it, but mind you, there have been signals there in volatility. I just don't trade that stock. That would have compelled you, if you wanted to do a put sale, this method would have said, no, you better do a vertical and protect yourself. Because with a vertical, what do you get? You get a soldier on your team, right? You're not just selling that cash secured put with the full downside, with a massive capital requirement. You're number one, you're doing a vertical a credit spread. You're getting that nice, defined, efficient approach to income. But you're getting something else. And I explained this in my meta video. I said, I put this vertical on because the metrics were telling me, look, all is not well. But I thought, I love Meta. It's just one of my favorite names. And it's bounced back like $200. And, I should have bought more down there, but oh well. But it's a name that now you only do these kinds of trades on stocks that you truly believe. So what does that take us back to? It takes us back to quality, metrics, cash flow. Meta, fantastic company. Cheap. When it was under $500, that is one cheap company. Now, of course, it looked like the global economy was imploding, so everything was up in the air. But once you get the blend of that rank and percentile above 50%, you need to be looking at verticals because something is going on. So now you have that extra long piece. So what did I do? Well, I sold at $600. I sold the 545.35 vertical credit spread, put credit spread. And I received $2 for that. For a $10 spread, I received $2. So that's going to be a $2. If I collect that whole $2, that's going to be a $2 win on $800 of risk, right? Because I collected 200, so my risk is actually 800. That's pretty good. That's a 25% return for 6 weeks of work or whatever it was. So that's pretty good. I get that $2, but the market collapsed and Meta went to the low 500s. So what happened? Well, my put spread got run the heck over. My long put was well in the money as well as my short put. And I said, this is my shot. This is why I have that long put soldier sitting there. When things are looking questionable, I want that soldier there so that I can play with it. What did I do? I rolled the 535 down to the 465. So I turned it into a larger capital trade, but I maintained protection below 465. And I said, man, if it gets down there, I'm going to sell that one too, because I got to own Meta at down at those levels. So it got down again and I sold out that put. So I made money on the 535. I made money on the 465. The stock rallied back. I got rid of it. It was dumb. I got rid of it before earnings, but I don't like to get involved in earnings. It's that they're low edge trades. But maybe I should have because I love Meta. But I got rid of it. I took the loss on the short 545, but I made something like, I don't know, $35 on the long put flipping. So in the end, the whole trade made me 20 bucks. I went in to grab $2 on the original vertical. I made $20 on that trade. I made 10 times what I originally had hoped to make on that trade. And it could have been better if I held on through earnings, but that's another story. Coulda, shoulda. 10 times what I originally wanted to make on that. That is putting the right kind of spread on. Now taking that lower put off at some point was going to jam up your capital. So you can't do that unless you have the capital available or you have margin. And you most certainly have to be willing to own Meta, because if it doesn't rally back, you're going to own Meta. But you have now just cut down your cost basis by a good amount by having flipped that long put over and over again. So that is really an example of using volatility metrics. And then I can add in that, down at 510 or wherever it was that I rolled down to the 465, that downside skew exploded. We saw put skew explode everywhere, like we haven't seen in many, many years, because the market was completely panicked. So, at that point, it really looked like the market was getting very, very washed out. I used some metrics on Spot Gamma. It was kind of funny. Like, it has a risk reversal thing, and every single stock was like hugging the left side, which means everything was just in full panic mode. Not funny, but interesting. So that is how you do it. These are the kinds of things we learn. I don't know, David, if you want to jump in here, but these are the kinds of things you learn in my programs, the Crush the Premium program, which you can check out, crushthepremium.com. Every now and then, for the people who sign up for Crush the Premium, which is really not expensive, for what you get, I've been told I should charge double to triple easily. But I want people to get in. I want people to become a part of the community. You get a couple months in the community where you can see me in action and understand that I'm not pulling your leg. We are doing things all day long, not one of these BS discords where they know like one trick. We are doing all kinds of stuff. I have the Leaps portfolio in there. I have risk gauges that keep you out of trouble. I have my cash machine room, different kind of trade, very, very conservative trade. You're just trying to grab a little bit of premium and you are giving up some of that upside, but it's very focused on people who are just really about extracting that premium, that income out of it. So there's a little something for everybody, and you get a couple months in the community, even with the Crush the Premium. Now, if you want to go up to mentoring, which is like $7,800, but it's a full year of mentoring, you will come out of that year. I'm Ivy League. I have an MBA from Cornell. You will come out with an Ivy League caliber tuition. You will know, and I teach everything. You will know volatility like, the back of your hand. You will know option income trading like the back of your hand. You will know investing like the back of your hand. So really excited about that. It starts in June. We can do payments. We can do all that kind of stuff. But if you just want to get a taste for this ecosystem, you can jump in with something like Crush the Premium. And then if you want to upgrade at some point, I will credit you that for mentoring and various other things that we have going. So are there any questions out there? I know we're running out of time. Happy to answer any questions. And I am a student of the markets, right? Like I'm an unabashed bull. I love markets. I believe in them. I believe in all that stuff. But you have to be able to pivot in this market, right? You have to be able to pivot. And I can't get my thing to work. I was going to show you guys where I pivoted. Have you been seeing my slideshow the whole time, David?
Oh, I was listening, but I was working on,
Oh,
you know,
okay.
archive stuff. So
Yes, yes.
I,
I'm just checking to
I,
see.
yeah, I mean,
Hopefully, because I'm having trouble bringing up my PowerPoint. So
I,
hopefully you guys were seeing that. Oh yeah, yeah, I
yeah,
can see
I
that.
was just seeing, Yeah, I mean, every time I looked over, I thought I was seeing the
Okay.
PowerPoint.
Terrific. Terrific, terrific, terrific. So yeah, I mean, look, this is let's see. Let me see. Testimonial. I have testimonials up the wazoo. Go to optionswithhans.com. I have video testimonials of people going, why didn't I find you years ago? Like literally. It's really terrific. It's gratifying. I love to be able to be this guy who's bridging the gap between the theory, the art, the science, the option guru grift that I'm seeing out there and the real deal. I'm just really happy to be a part of that. I'm trying to build a movement here. So I hope jump on board, check it out, look into what we've got here. I can't find. I'm looking for this slide where I basically called the MTI indicator called the sell off at just under 6,000. And then it's slow to get back in, but it gets you out. It gets you out. So that's the indicator you get with all the programs. And that's it.